Well, greetings, my beloved clients and friends. I got a new hat, which is the Platinum Wealth Management hat. Hope you like it. So, last couple of videos, we've been talking about some of the principles that we have learned over the years and that we adhere to as best as we can. And I said that I wanted to show you an example of the actual application of that. And so, what I want to do today is talk in some detail about a company that we recently bought, that we invested in, and that was United Healthcare, which we bought back in June. And so I want to tell you about the thought process that went into that decision, to give you a perspective on what we do and how we do it. So first of all, the question we ask is, when we look at a company, well, how do they make an income? How do they make money? And so United Healthcare is the largest in their industry, and they're a health services provider. So basically, if you have health insurance, you have a company like United Healthcare, or you may actually have United Healthcare because they're the biggest in the industry. And so you pay them a premium, and then when you go get a service, they pay for that service minus a deductible. So they don't own the hospital. They don't provide the service. They just pay for the service, and you pay them a premium. So there's basically 4 divisions within that company. The United Healthcare segment offers consumer-oriented health benefit plans and services for national employers, public sector employers, mid-sized employers, small businesses, and individuals. Okay, that's what they do. Healthcare coverage, Medicaid plans, individuals over 50, children, the medically underserved. So they have a huge market, right? Pretty much almost everybody. And the thing was, like, when Obamacare passed, they said, there's a few million people in our country that don't have insurance, right? But there's hundreds of millions that do. And United Healthcare is the provider for a good chunk of them. They're the largest in their industry, okay? They also have a couple other segments of their business: Optum Health, Optum Insight, and Optum RX. So Optum Health provides care delivery, care management, wellness, and consumer engagement and health financial services for consumers, care delivery systems, providers, employers, payers, and public sector entities. So they're kind of vertically integrated within that healthcare industry, which is, I think, outside of the government, the largest industry in America, the largest employer, at least. Government and healthcare, like, those are the 2 largest employers in any city and in the country as well. Optum Insights segment offers software and information products, advisory consulting arrangements, managed services, outsourcing contracts to hospital systems, physicians, health plans, governments, life science companies, and other organizations. Okay, so they've been expanding, and they've been taking up market share and adding to their business complementary services. And then the last one, Optum RX, provides pharmacy care services and programs, including retail network contracting, home delivery, specialty and community health pharmacy services, and purchasing and clinical capabilities, as well as development programs in the areas of step therapy, formulary management, drug adherence, and so forth. So we asked ourselves, can we understand that business? And I would say yes, because personally, I pay healthcare premiums, so I understand that. I'm a customer of the industry they're in, right? And I get it. I pay a premium when I go to the doctor, right? They bill them. Maybe I might have to pay a deductible, but they bill them. So it's like insurance, right? And there's people like me that pay a premium every month and hardly ever go to the doctor. And then there's other people that are maybe more hypochondriacs. They pay their monthly premium and they always go to the doctor. And there's some average. And it's really, there's a law of big numbers. And because they're the biggest, they have big numbers in their favor, and they could estimate to a reasonable degree of certainty, on average, this is how much we're going to have to pay per person for services throughout the year. So then we should collect a premium that gives us a profit margin, right? That's how their business works, right? And there's some ebb and flow, but it's a check that comes in from every customer every month. And in many cases, for them, most of the cases, it's not the consumer that's writing the check. It's a corporation or it's a government, and it's it's part of the benefit plan, and it's good money that comes in. It's very consistent cash flow in, and there's also consistent cash flow out because people are always sick. But they can manage that, and they've been able to do it for a long time, and they've been very profitable at it. And so when we asked ourselves, how do they make money? We understood that. And so then we asked ourselves the next question, which is, well, how much do they make? And we started to look at that, and their revenue in the most recent 12 months was $333 billion. That's a lot of money that they make. That's from the premiums they collect and from those other services. And about 22 billion of that hits the bottom line. And we looked over the last decade plus, and every year they've made a profit, in the good times and the bad, through COVID and through inflation and through Democrats and Republicans, and it's been growing. The revenue's been growing at about a consistent clip of about 10% a year, and the earnings have been growing about 15% a year. So the earnings are growing faster than the income, and that suggests to us that they have economies of scale, that as they get bigger, they get more efficient. So we like that. Their cash flow has also been growing, and their cash flow is bigger than their earnings. That means the cash that comes in, they don't have to pay tax on all of it. They have some tax advantage that they do that their cash flow is actually more than their taxable income. So we like that too. Okay, and it's growing, and their dividends, they pay a dividend, and they've been raising their dividend over 15% a year on average over the last decade consistently. So imagine if you're getting a dividend from them, and each year they raise it up to the tune of about 15%. That's pretty good. That much more than keeps up with inflation. It keeps up with inflation and then some. And the two big industries that have been have grown faster than inflation for decades is healthcare and education. Right, the inflation of prices within those two industries has consistently exceeded inflation. Okay, so we understood how they make money, and we figured out how much they make. So then we asked, well, how much would I pay for that nice, solid, healthy, growing income stream? And when I looked at net income of a little more than 20 billion a year, and cash flow north of 25 billion a year, and I did the quick math in my head, I said I'd probably pay somewhere between 500 and 6 billion for a company like that. Right, because I usually like to go in and not pay more than 20 times that cash flow, which would represent a 5% interest. And I said, that's what I would be willing to pay for a company like that. Maybe a little bit more, because it's so consistent and it's growing so well, and it's in such a dominant market position, and it's in an industry that I think has legs, because we consider the demographics, and you say people are getting older, and as they get older, they get sicker, and their biggest priority is healthcare. How am I gonna I can't live without my health insurance because that could potentially be a disastrous expense. And so it becomes a more and more important product. And then when you look at technology, I think technology is in their favor, that they're over time, I think they're going to be able to be more efficient in their operations. They're also a capital light business, meaning they don't own the hospitals. They don't own the brick and mortar. They just pay the providers, right? And they get paid. So for them to add customers, they don't need to build another hospital, right? There's no big CapEx. They don't need, if their customer base grows, they don't need more warehouses or more storage or more to deliver that. So I like that. I like that they could grow unencumbered by huge capital expenses. And there's opportunity for them to expand vertically and horizontally as they have through acquisitions and organically. So from all those perspectives, I like the company, and I figured, I'd be willing to pay at least 500 to 600 billion for a company like that. So then I looked at, well, what's it trading for right now? And when I bought it on June 16th, it had a market cap of 435 billion. I said, what? That's cheap. It's trading at 435 billion, and I would have easily been happy paying 500 to 600 billion for it. So what was going on at that time? Well, it turns out that they had been in the news because they had made an announcement, and they had said, look, during COVID, a lot of people didn't go in to get their surgeries because they were afraid to go to the hospital or whatnot, and hospitals were focusing on COVID. And so now that COVID's passed, there's probably a backlog of surgeries. And that, over the next year and a half or so, we're going to have to work through that backlog. So we're going to have to pay for more surgeries than normal. And so what you can interpret from that is that, the last couple of years, maybe their earnings were better than normal because they didn't have those expenses of those surgeries. And in the next year or two, maybe their earnings are going to be a little bit less than normal because, they have to work through this backlog of surgeries. And Wall Street gave them a beating. They brought the price down. They had traded as high as $558 a share back in October, and they had drifted down. When I looked at them, they were trading at $467 a share. They were down over 16% from their recent high. And I said, well, I get it, but I think Wall Street overreacted, which is not at all uncommon for Wall Street. And I said, I think at this price, with this pullback and this, what I believe to be an overreaction to this news, it represents a good entry point. So we bought it. We bought it at a price that I thought was really good. And that announcement came in between earnings calls, and about a month later, they had their actual earnings call. They reported their earnings, and they were better than Wall Street had expected, better than they had feared. And they gave guidance for the rest of the year, which was also better than they had expected, and better than we had expected. And so we were very pleasantly surprised with that earnings call that came in after we had bought it. And sure enough, the stock went back up over $500 a share. Okay, so like I said, first we asked ourselves, how do they make income? We understood that. How much do they make? And we figured that out. And how much are we paying for that? We felt like we were getting a good price. And so then we asked ourselves, well, how much do we expect this income to grow? It's been growing at a really nice clip, and do we expect that to continue? And we looked at some things that I had alluded to before, like the demographics. Are they in it? Are the demographics in their favor or not? We asked that question, and there were some things that were in their favor, some things that were not. So it wasn't overwhelming one way or the other. So we believe there's going to be some ebbs and flows that they could navigate through. But one thing we liked is the ability for them to use technology to lower their costs over time. through things like telehealth. If they could keep their customers healthier or serve them remotely, that's going to lower their costs, and the premiums are probably going to stay about the same. Because when have you seen your premiums go down? So that represents an opportunity. They have opportunities to expand through acquisition and organically. And another thing that we saw when we compared them to their peers, among whom would be Elevance Health, also known as Anthem, Humana, Centene, Molina, right? These are their competitors. They run their business very well. They have the lowest medical loss ratio among their peers, right? So it points to a well-managed company. Okay, the consistent revenue growth, earnings growing faster than revenue, their commitment to paying a dividend or raising that dividend. They're a shareholder-friendly company. It seems like they have economies of scale. They're capital light. They have a technology headwind, I believe, and they have a long history of acquisitions. In 2015, they bought Catamaran RX. In 2019, they bought DaVita Medical Group. Also in 2019, they bought Equian. And I like that they were doing a lot of acquisitions when interest rates were really low. They were getting cheap money to buy these companies, and they weren't overpaying. And they didn't do like some companies that, they bought a huge acquisition in 2021 when prices were really high. Now, what could be the limiting factor? Well, one limiting factor that we see, because we want to look at both sides. We don't want to look at this company simply with rose-colored glasses, is that international expansion is not likely. And if you consider the business, it's about relationships. They have relationships with these, government, teachers unions, big state employee unions, and the politicians. Imagine their lobbyists. They probably have a huge lobby in Washington. They have relationships with hospitals and doctors, and so it's very much a relationship business. And being number one, they're probably entrenched in that. So I don't worry about who's going to win the next election, because I could promise you, whoever wins, they'll get to know the UNH lobbyists by name. I believe that. Okay, and so that gives them a durable competitive advantage. Those relationships that they have, that web of relationships with suppliers and customers, big corporate and government customers. But that also gives the company in some foreign country the relationship compared to them if they try to go into that country, right? They don't have the relationships with, they don't have the lobby and with the hospitals and the big employers and all that. So it's hard to break in. It would hard for a competitor to break into their business, but it'd be hard for them to break into the business in another country. And they tried. They tried to go into Brazil. They partnered with the largest healthcare provider there, which was Amil Parta. I don't know how to say it. That was back in 2012, and they had the opportunity to acquire a 90% interest in that company. And it just really hasn't worked out. It wasn't a huge investment, so I don't think it's going to be a gain, but not a huge loss either. And they're actually trying to exit that. So considering that, maybe they're not going to become this worldwide healthcare provider, still, they have a lot of ground to cover here in the U.S. and they're in a very good position. Their cash flow is very good, their earnings are very good, their relationships are very good. So with all that being considered, we really like them. We think they do have years of growth ahead of them. And so what we did with all that information is we projected out to the best of our ability, what do we think their income and expenses are going to look like over the next 3 years, right? And based on that, what do we think the company would be worth in the next 3 years? And so we modeled that out, and we came up with a 3-year price target of $668 a share. We bought it at $467, and they pay a dividend, which is growing. So we estimate if our estimates are accurate, we would see a 14% annualized internal rate of return on our investment. And that meets our hurdle, which is 12%. So we liked it and we bought it. And when the first earnings call came out, it exceeded all our expectations, and the guidance they gave was higher than what we had projected. So we were so far we've only owned it for a couple months, but we've been very happy with it. And what we're gonna do is not necessarily watch the price movement every day, but we'll be on those earnings calls every quarter. And as they continue to give us guidance that is in line or better than what we had modeled and expected, we'll continue to hold them. So I want you to see that, when we looked at a margin of safety, we said we have a pretty good margin of safety on this company. We're not worried about what Mr. Market is pricing this company on a daily basis. And that's the work we do, and that's why we bought it, and that's the type of research that goes into most of the companies we own. And just because we did a 3-year price target, that doesn't mean we're gonna buy it and then sell it in 3 years. We may sell it before that if it runs up more than we had expected, or fails to deliver on what we were hoping it would accomplish. There's some material change, or we may hold it longer than that if it continues to grow consistently like it has. So, but that's just a marker of what we look at to try to get some estimation to see if it would be worthwhile to buy. Okay, so that, I hope that gives you some insight to not worry about the day-to-day price of United Healthcare or anything else in your portfolio or the portfolio as a whole, and just focus on the fact that you own a company. So we don't buy baseball trading cards. Okay, so a baseball trading card, like say for Derek Jeter rookie card, right? It has a value, and people are trading that, but they don't really own an interest in Derek Jeter or his income stream, and they don't have the right to vote on his investment decisions or who he hires as his agent or attorney or accountant, right? They have no interest. It's just trading and speculation on the market. And when you buy a stock in a public company, you buy an interest that is traded, like that trading card, but you also buy an ownership interest in the actual company, right? I am a part owner of United Healthcare, and my clients are as well. And so I represent my personal interest and the interest, which is a meaningful interest. Now, I mean, let's be honest, it's a $500 billion company. I don't even own 1% of it. I don't even own, which would be $5 billion, right? I don't even own 1/1000th of it, which would be 500 million. But I do have an ownership interest, and it's big enough that I could have an audience with their investor relationships and express my opinion and ask them questions and go and vote and go to their meetings and that type of thing. So those people at work for United Healthcare work for me. I am a shareholder. The dividends come to me, right? I'm entitled to a portion of their cash flow, and I'm an owner of that company. Okay, so you don't just own a trading card in United Healthcare, if you will. You actually own the company. Okay, so they're not going away, and they have been growing. Now, they might not be around forever, but the benefit of there being a market to trade it, that at any point in time we could exit that position as well. So if we saw things that started going the other way, we could always exit it. But while it's going well, we're going to hold on to it and not worry about, you know, what the kids that are playing with UNH trading cards are pricing it at every day. We want to know what's the actual business doing, and that's how we make our decision. And I hope this gives you some perspective, and I hope you have a great day.